Forex trading is indeed the largest financial market in the world, with a daily trading volume of approximately $5 trillion, making it highly liquid and accessible to traders around the world. In Forex trading, traders speculate on the value of one currency against another, with the goal of making a profit from the difference in exchange rates between the two currencies. For example, if a trader believes that the euro will appreciate against the US dollar, they would buy the euro and US dollar currency pair, and if the euro indeed increases in value, they can sell it back for a profit. Forex traders can trade a wide range of currency pairs, including major pairs such as euro and US dollar, British pound and US dollar and Japanese yen, as well as exotic pairs such as US dollar and South African rand, and euro and Turkish lira. Each currency pair has its own unique characteristics, and traders use technical and fundamental analysis to determine which pairs are likely to offer the best trading opportunities. One of the key advantages of Forex trading is that it offers traders the ability to profit from both rising and falling markets. Unlike traditional investments such as stocks, where traders can only make a profit if the market goes up, Forex traders can profit regardless of whether the market is moving up or down. However, as with any form of trading, Forex trading carries risks, and traders must be prepared to manage those risks through the use of proper risk management techniques, such as setting stop-loss orders and using appropriate position sizing. It's also important for traders to stay informed about economic and geopolitical events that can impact currency prices, and to have a well-developed trading plan that aligns with their trading goals and risk tolerance.